Good morning, good evening, good afternoon to wherever you are in the world. Welcome back to another coffee hour. All right. So today is going to be a pretty oil commodity based heavy news cycle. I think this is actually really important from a macro perspective. So we're going to be covering that. We do have a little bit of news for a new U.S. chip rule that is potentially going to be rolled out. And I think that's going to change the game for our chip makers, especially all of our semiconductors, right? Companies like NVIDIA, AMD, just to name a few, because those are the top dogs, right? We also have Marvell earnings that we're going to cover, because I did say that I wanted to cover Broadcom as well as Marvell in an earlier stream. So we'll be covering them. And we'll just have some general market news, all right? So as always, I appreciate everybody joining. Let me just post this to X real quick. Hold on one moment here. Market news, all right? Because on X, it doesn't auto post. StreamYard is still broken. They have not fixed this. I don't know how they have not fixed this. But hey, whatever, we'll just do it right now, do it live. All right. And of course, all of the show notes will be posted down below in the description of this video in case you guys want to go back and look at those articles yourself. All right. Okay, so let's see what we got going on here. All right, so let's hop over to the stream, guys. And again, as always, I appreciate you guys joining me for this stream. Okay, let's see right here. Boom. We got Victor Sank in the chat. He sends some rocket emojis today. Today, I don't know, man. Today was just weird. Today, I was looking at the aftermath of the market, and it was just weird, man. I don't know what to make of it right now. Bitcoin had had a bit of a drawdown back to the 70 range last time I checked. Hopefully, it doesn't go back even lower, because if it does, that means we're going to probably be heading lower, in my opinion. If we do, I'll just continue to add more under the 60K range, but I would really like to continue going higher, but we'll see. Yep, looks like a regular pullback. We got a super chat from Ben McKinney. I appreciate you. No comment, but I do appreciate it. All right, it's going to be going to my coffee fund because I just ran out of coffee. So today I have to make a purchase. I'm probably going to go with something maybe from S-Bucks or Starbucks. So I did just finish off a can of Illy, I think it is the brand. And before that was a can of Lavazza Espresso. It was so damn delicious. All right, guys, let's get into the news stream. We got a lot to cover. All right. And I appreciate each and every one of you joining me on this stream. All right. So let's get going. All right. So here we go. S&P 500. All right. This is the heat map. We can see where the major sell-offs are happening or the major pullbacks. Looks like everything, right? Looks like everything. Healthcare, communication services, consumer defensive. Look like some of the Mag 7 / Mag 10 was kind of leading the way here. We have Microsoft, Amazon up, NVIDIA barely making it, and Broadcom, all right? Broadcom just had their earnings. Looks like that rotation back to software, guys. Hey, looks like that rotation back to software. All right, we talked about this. Tom Lee talked about this. We had several pundits on the show, looking at their videos. They were all talking about this. Maybe this is that turnaround for software. There was a really interesting video by Dan Ives. He was on the Schwab network, Schwab, the bank, the brokerage, company, whatever. But he was saying that, Anthropic coming out with that security feature and it disrupting the entire software sector is a fairy tale. They have an insane amount of moat for most of these companies like a CrowdStrike. So, I thought it was rather interesting, especially coming from him, even though, the market sold off. The market pretty much beat down the software sector pretty hard over these last couple of months. So let's add on AI disruption to it, right? But it looks like, maybe it's coming back. Maybe that risk appetite is starting to come back. So that's always good to see. All right. Moving on, we have the S&P 500 down 56 basis points, all right, ending in the red today, all right, over the last couple of days, trading pretty much down, all right, and we'll see if tomorrow we get a pump up and we keep it. Again, this is just following the same trend we've been seeing, lots of volatility in the market, all right. As a matter of fact, I do want to take a look at the VIX. I did not put the VIX up here. Let's take a look. All right, so the VIX is at about 24, right? 23.75. I like to monitor the VIX because that will give us a signal whenever there's a higher risk, right? This is more or less the fear and greed index. Okay, you can look at the fear and greed index and kind of draw your own conclusions from there. I like to look at the VIX as well because it gives us a pretty good picture of what's going on. And as you guys can see, it's year to date, it's starting to climb. Okay, so it's starting to climb. That is not good, right? That means there's more probably volatility coming to us here in the short term, especially with, we know that what caused this, right? What happened over the weekend? You had the invasion or the missile strikes in Iran, et cetera, right? The Hormuz Strait coming into contention. So we'll see what's going to be happening there because that is going to rock the global markets. That's pretty much going to take up a majority of this stream, is talking about the oil markets and what's going on over there. I discounted how important that stuff is. So we're going to cover it, as I learn, you guys are going to learn with me, right? Some of you guys probably already know this, right? So IGV is the expanded tech sector software, which we just covered. And we see that it actually had a pretty nice bump up, 2.3%. All right. Year to date, still not doing the hottest, right? It is still down. It still got punished, but we see that from 23 February to present day, it looks like it had a 13.88% gain. So it looks like some money is rotating back into software. And they've been getting pummeled. They've absolutely been getting pummeled. If we look at the last, 6 months again, still down quite a bit. All right, still down 24%. So this could potentially be a nice swing trade for those who might want to take on a little risk or who are, want to swing trade something like this, right? For gold not doing so hot right now. Excuse me. Sorry for the coughing. Got to stop smoking cigars. Okay. Anyways, we have the gold chart. We're down 1.2% for the day, but year to date, we're still up 17% over the last 5 days, down 3%. We're going to be going over why. And the reason why is because the US dollar is doing well, right? The US dollar is actually climbing. Over the last 5 days, up 1.24%. Okay, so whenever we have a strong dollar, that's typically weak for gold. And I was curious why that is, right? I was just curious why that is. So as I said, we're all going to learn here together. But it looks like, yes, a strong dollar generally weakens gold prices as they typically share an inverse relationship, right? So when the dollar strengthens, gold becomes more expensive for foreign buyers, reducing global demand. A stronger dollar also boosts treasury yields, making a yieldless gold less attractive, often leading to a drop in price. And we definitely do see that treasury yields have been climbing. All right. Unfortunately, we had the 10-year back above 4%. I think it's at like 4.18% last I checked. That's not good. Right. And then the longer tail yield, the 10-year, the 20-year, the 30-year, those are climbing as well. So we don't, especially in the commercial real estate space, you don't want a high 10-year treasury bill. But anyways, moving on from that, we have silver. All right. Silver is also taking a beating today, down 1.42% over the last 5 days, down 10%. All right, almost striking 11%. Year to date, still up about 13%. So it is still the second best asset year to date. VNQ, which I have not covered in a very long time. VNQ is the real estate index fund from Vanguard. All right, so it's a total REIT index. It includes not only the regular standard REITs, your housing, your manufactured homes, your multifamily apartment buildings, your data centers, your malls, et cetera, but it also includes mortgage REITs. Okay. This has actually been doing well this year. All right. This is up 7%, almost 7%. This is beating the S&P 500. All right. So again, real assets. Real estate is getting a tailwind from all of this, one, debasement trade, two, inflation, three, this idea that the dollar is going to be weaker in the future, because that debasement trade is still true. At least in my mind, it is. I still believe in that debasement trade that's going to happen, or that is happening. It's not going to happen. It is already happening. And that's going to make real assets all the more valuable. So this is why, in my opinion, why real estate is doing so well. All right. So, and again, real estate has been in a pretty bad bear market since the height of 2021 all the way into 2022. I mean, you guys can see here, it has not, it has not been doing well, right? It's been trading pretty much flat. But with the interest rates coming down, that's bullish for real estate, and with the 10-year Treasury coming down as well, that's also bullish. And again, Secretary Scott Bessent and the Trump administration is focused on bringing those 10-year or bringing those Treasury yields down. All right, so good for Vanguard Real Estate Index Fund, good for REITs, good for real estate in general. And again, I had mentioned, or there was a question from one of the viewers, what's a big contrarian bet? And in my opinion, it would definitely be real estate, because real estate has been just hammered over these last couple of years. But it looks like we may potentially be getting out of that bear market. All right, for Bitcoin, 71 really is hovering at 70,000 last I checked, right before the start of this stream. So Bitcoin, had a really nice pump up, and it looked really good. So hopefully we can continue the trend up. Again, this Friday is going to be really telling, and going into the weekend, I think will let us know, right? But yep, that is Bitcoin. All right, nothing new over there. It's just a volatile asset. Going back to what is this? Oh, this is nothing. Going back to VNQ, we have a comment from Ben McKinney. IYRI from Neos is probably a good one, and I would agree with you. I would agree with you that IYRI from Neos is actually doing pretty well. And of course, most products from Neos are doing well. Neos is kind of the gold standard, in the high yield space. But yes, I would agree. IYRI is doing really, really well. Let's take a quick look at the chart. I had considered in the past, if I wanted to drop into this, I opted against it just because I don't want to be in real estate at the moment. But if we're going to have a really nice turnaround, maybe potentially. All right. But over the last month, up 1.44%. Over the last or year to date, up 2.88%. And of course, you got to think when you have an income product, they're paying you out those premiums, they're paying you out those distributions. So that's why your share price is not exactly the same. But the holdings that Neos real estate high income ETF actually holds, I really do like most of those holdings. I don't know if they changed them since the last time I looked, which was probably months ago. But I did like the holdings when I did look at them in the beginning. So, again, gold standard. All right. Over the last year, we can see that actually been trading pretty flat, which is not bad. I mean, it's still down about 4%. That Liberation Day, but you guys can see, I mean, it kind of recovered and then for the most part traded flat while still distributing a nice distribution. I think it's about 12% if I'm not mistaken. So yeah, I mean, hey, Neos is killer, man. Neos really owns the space. Okay. We have some macro news or market news coming tomorrow. This is going to be really, really important, which is going to add to the volatility, which is probably why the VIX is also, starting its nice little climb up, right? But we have the U.S. unemployment report and the unemployment rate and hourly wages, U.S. retail sales, and that's about it. I think those are really the big ones. So tomorrow, that will be important to look for. I think that will drive some of the market sentiment. But, as we know, whenever these reports come out, usually you get a little bit of volatility, and then usually it goes away, right? It either goes away that next day, right? So if there's a huge pump to the upside, don't get excited. Just be prepared for the drop the next day, right? We'll probably see some type of volatility here in the next day. And of course, all this stuff influences the Fed rate cuts, but we already know, right? We already know that we're not getting rate cuts until a new Fed chair is put in the seat, right? Kevin Warsh. So we have to continue waiting for Jerome Powell. Haven't heard much about Jerome Powell or the Federal Reserve over these last couple of weeks, actually. It seems like that lawsuit or whatever it was from the Trump administration kind of just, it's either still getting battled out in court or something, but it seems to have just died out. Like it's not in the mainstream news anymore. So probably a good thing, at least from the Federal Reserve perspective, because they're not supposed to always be in the news, right? Especially for something of this magnitude. But anyways, moving on from that. Okay, so we're gonna listen to a quick clip of Dan Niles. All right, investors need to be broadly diversified to get through the market period in better shape. So he's gonna talk a lot about just being diversified across different sectors. He's going to bring up oil. We're going to get into a whole segment about oil here in just a moment. All right, so let's get into this.
Is warning about chasing this, though. He says, don't get too excited. It may not be the all clear here. Let's bring in Dan Niles. He's the founder and portfolio manager at Niles Investment Management. Dan, before we just jump in to the software piece of this, what do you make of the broader market sell-off? The Iran war, the higher oil prices, higher yields now that we have to contend with. Do you just look past that?
You can't look past it, obviously, Kelly. But I think what we're all trying to figure out is this a short war, meaning less than a month? Or is it sort of medium term, which is a bigger problem? Or does it last for a long time, in which case I'm talking oil above 100, at which point you're probably going to end up with a global recession. So I think that's what everybody's trying to figure out. I'm more in the camp that this is more in the span of hopefully a month. But if you go back to when Russia invaded the Ukraine, that was February of 2022. It's been 5 years. And it's still going on. But the good news is oil prices, after initial issues, obviously were well contained. And so the economy went on just fine. But if you're looking for the bull case, you can go back to Russia's invasion of the Ukraine and the fact that the market ripped during 2022 anyway, despite there being no end in sight.
Later in the year, we had a nice little thing called ChatGPT that came on the scene. Dan, a lot of people are pointing out the irony that in the time since the conflict has broken out, you have software technology outperforming. I mean, those would not have been the obvious trades. Even if, this is what we always say, if someone had told you the news and then said how to trade it, I don't think a lot of people would have said, oh, go pick up software in the Mag 7.
Well, if you look at what I wrote on Sunday, I thought the rally in software would continue. And then I put out a note yesterday as well on X talking about the fact that I thought it would continue. Because even if you assume everything that Citrini Research said at the beginning of last week is correct, and then you saw Block go ahead and lay off 40% of their workforce, and they said it was AI, and this all happened last week. The software index finished the week up 1%. The S&P was down 0.4, and that's why I wrote, I thought this could continue. And even if you believe that this is, the end of software and it's going to continue to go down, and so you use the 0102 analogy, when the S&P was down 49% over 2.5 years, you still had 7 rallies that averaged 14% each in the S&P 500 that occurred over 2 months on average. Those are huge moves. So my feeling with software is, and that's why I have a lot of my exposure right now, because my belief was in the short term, you would get this kind of rally, and that has continued. And if you look at IGV as the example of that, which is the software ETF, it has been bought open to close, if it closed here, for 8 straight days. It's been on better than average volume. And so at a certain point you go, yeah, 35% sell off from September to its lows. You're going to get a counter trend rally, and could it gain back half of that? That's kind of what happens during these vicious sell-offs, even if this is not the bottom.
The NASDAQ 100 is down 1.7% this year. The S&P small cap 600 and mid caps are higher. And we are at war. I understand the old adage, you buy at the sound of cannons. I get it. But I just feel like, does it feel like to you, Dan, that the markets are overly complacent, given that we are in the real position of running out in the world, not in America, of pretty significant commodities if this continues for a couple of weeks?
Well, that's true, Brian, but you go back to Russia, Ukraine, and have come up with the same conclusion, right? There's a lot of rare earth minerals, agricultural stuff coming out of the Ukraine. And so that was the fear. What did 2022 end up doing? It ended up being up 27%. Even so, you can look at this. And so I always say it's not the news, it's the reaction to the news that matters, because people will make up reasons to support why the stocks are doing what they're doing. Usually price leads the narrative. It's not the other way around. And so I'm looking at this going, well, I know what I believe, which is stocks should be a lot lower. But the market is telling me that this is going to get resolved. And whether that's because the number of missiles flying keeps going down every day, and so they have to run out of that at some point, whatever it is, the market's trying to sort through this. Now, I do believe, which I've been saying for a while, you need to be hyper selective. And so I've said on CNBC before, you need to get messy. And what I mean by that is, right, utilities, the U is up 9% year to date. Materials, energy, staples, industrials, you look at that 5 subsectors of the 11 of the S&P 500, they're up between 9 to 25%. You're only suffering if you're in tech.
Yeah.
Right. So, and there's some good reasons for that. But if you're diversified, you're not having a problem. The Russell's up 3% year to date. The Magnificent 7 are down 7. The equal weighted S&P is up 4. The S&P might be down 1% year to date. So you really need to be more diversified and broadly diversified. And what sectors aren't going to get wiped out by obsolescence due to AI and what has a lot of heavy assets.
Right.
I think if you have that kind of mix, you can get through this period in much better shape.
So what do you guys think? I mean, should you be diversified, or because there's so many trains of thought when it comes to diversification, right? Diversification is the only free lunch in the market. It's the only thing you can really truly get, right, for free without paying. And there's also very, was it Drunken Miller, very, very famous, hedge fund manager. He says he doesn't diversify. He has just a couple holdings with the highest conviction. Warren Buffett, he talks about diversification, but I mean, if you look at some of their holdings, I mean, they're pretty concentrated as well, at least from the equity side. So what makes sense, right? What does make sense in a period like this? Diversification, can also be a double-edged sword, where you'll have, lots of diversification across different ETFs, different sectors, oil, energy, infrastructure, equities, tech, software. You also have maybe real estate, maybe some treasuries, I don't know, bonds, et cetera, et cetera, et cetera, right? So you have the diversification right there. But you also potentially can water down your returns by doing that, right? And what I mean is you're spreading each dollar across different ETFs, right? So it gets harder to move that needle, unless you have like a really large portfolio or a lot of money, a lot of dry powder just to put into this into this diversification. It gets kind of hard, especially when you say you get your paycheck, right? You get your paycheck $100, and you're gonna put $100 into the market. Are you going to put $5 in 10, 15 different ETFs or something, right? Are you going to do that? Or are you going to just go heavy into one ETF, or are you going to just sprinkle it into 3, ETFs for, real estate, energy, so on and so forth, right? So in my opinion, it just gets really hard to move that needle when you're overly diversified. So that's actually one of the struggles I'm, working through. I wouldn't say that I'm working on it every single day, because, I have my highest conviction picks, right? I've shared that on this channel multiple times: Palantir, NVIDIA, Robinhood, BM&R, MSTR, right? But MSTR is the MSTW from Round Hill, right? So those are my highest conviction plays. I have gold as more of a hedge for broader macro stuff, right? I started to dip my toe in the metals, silver miners, gold miners, copper miners, a couple, individual mining companies, USAR, USA Rare Earth miner for one, UAMI, US Antimony Corp as another. And, it starts to, I'll go in large, not large, but I'll lump some into these positions and then just let them ride. Right. I won't really try to dollar cost average. I think that's another thing that comes into all of this. Do you dollar cost average when you're diversified, or do you just lump sum and then just let it ride? Right. So it's a really interesting topic of discussion, I think, because there's 100 different opinions out there, and you have very prominent, fund managers out there that say do one thing or the other, right? They'll say diversification is easy. That's what Warren Buffett says. Buy the S&P 500. You can't go wrong. Over long periods of time, you're going to beat most, traders, et cetera. But the other side of that is, well, you can have outsized returns for taking outsized risk, right? And I think that's what we're all trying to achieve, is these outsized returns, but, at the cost or expense of what risk, right? Because you could potentially lose the shirt on your back. Don't take out loans to buy, ETFs, et cetera. Right. All right. Anyways, I just wanted to cover this. I thought, just the thought of diversification was really important, especially right now in this time. We have so much volatility. There's brand new ETFs dropping almost every day, right? It doesn't matter if it's in the high yield space, doesn't matter if it's just a regular ETF. I mean, there's ETFs that, Skeptic in the chat, he's digging up from freaking ages ago that have been around for a long time, and they're finally starting to break out, right? XLE, which has gone really unnoticed for a lot of people, I think, is having a really good couple of months, right? It's been having a really good couple of months, especially when there's all this demand around energy. And then you start getting into themes. You start getting into themes, or thematic investing, or macro investing, based on the narrative, based on what you think, that you have the debasement trade, the AI trade, the data center trade, the government super cycle, and defense spending. Do you get into defense ETFs? So it's just so much to actually include in a portfolio, right? And then again, when you start overly diversifying, not only are you going to have overlap, but you could potentially water down your returns over time, right? So I think it is a really interesting topic of discussion. Anyways, we're going to move on to the juicy part of the news cycle. All right, this is going to be more or less about oil and the conflict that's happening in the Middle East, as well as some of the impacts or some of the ripple effects that it's starting to have or could potentially have on global markets as well as the stock market. Okay, because a lot of this, I discounted how important this was, but apparently I did not know this. The Strait of Hormuz accounts for 20% of global shipping trade for energy. That is a huge amount, right? And then you obviously know that Russia is not exactly friendly right now to, one, the United States, but also two, most of, Western aligned countries. They're trying to back them, into a corner, the Russians into a corner to basically settle for peace, striking a lot of U.S. oil refineries, U.S. oil or energy infrastructure, et cetera. So it is getting crazy, but the Strait of Hormuz not allowing shipping through in and through is a big deal, not just for the United States, but for other countries around the world. Southeast Asia they have, I think, about a couple of months, maybe less than that, maybe a couple of weeks worth of oil reserves. You have Korea that was on, talking about they have enough oil reserves to last them. And, this is impacting, secondary effects, companies that need energy, that need oil, right, to operate. So there's going to be a lot of impacts from this war. And there's a lot of misinformation coming on about whether Iran wants peace, Iran doesn't want peace. Iran wants this, Iran doesn't want this. The U.S. said they want peace. Then the U.S. backtracks. There's a lot of misinformation going on. And of course there would be, right? Of course there would be a lot of misinformation going on. I mean, if you hop on X, if you spend any amount of time on X, you will see the amount of misinformation, the amount of bots that are out there saying one thing or the other, or Threads or Facebook. It doesn't really matter. Any social media, you're going to see just an insane amount of misinformation, right? And it's even impacted some of my own, personal news sources that I go through. I have to double check them even more carefully now and look for the actual articles covering them from mainstream media, just to make sure that the facts are the facts, right? That it's not being construed or even fake. Okay, so anyways, let's get into it, guys. All right, U.S. crude oil tops $80 per barrel as escalating Iran war disrupts global fuel supply. All right, so U.S. crude oil prices on Thursday topped $80 per barrel as the escalating Iran war disrupts global fuel supply, with traffic in the Strait of Hormuz at a standstill due to attacks on tankers. President Donald Trump said Thursday that further action to reduce pressure on oil is imminent. Trump said Tuesday that the U.S. would offer political risk insurance and naval escorts for tankers. All right, Iran claimed to have struck an oil tanker with a missile, according to a state media report. The IRGC ordered a closure of the Strait of Hormuz earlier this week and threatened to attack tankers passing through it, to state media. All right. Tanker traffic through the Strait of Hormuz has come to a standstill since the U.S.-Israeli war against Iran began, as ship owners are worried about the volatile security situation. About 20% of global oil consumption is exported through the Strait. All right. The Trump administration does not have a timeline for when the Strait will be safe for commercial shipping again. White House Press Secretary Carolyn Leavitt told reporters Wednesday, "I don't want to comment or commit to a timeline, but certainly it's something that is being calculated actively by both the Department of War and the Department of Energy." So this is going to have huge impacts on the global market. I'm gonna front run this little thing, but I did ask ChatGPT, what are the impacts of oil prices increasing? Because now we're starting to hear that there is a potential for inflation and a potential for recession if the Iran war is prolonged. And of course, we don't know how long that can last. It could be days, could be weeks, could be months. Again, this is not a stand, like, I don't know how to put it. If you know Iraq and you know Afghanistan, Iran is not Afghanistan, and Iran is certainly not Iraq. Okay, so this is a very different animal altogether when it comes, to warfare. So The prompt was, how would the increase in the cost of oil also increase inflation risk and a possible recession, right? An increase in oil prices can push the economy towards higher inflation, higher recession risk, because oil is a core input in almost everything in the economy. When oil rises sharply, it creates a chain reaction across multiple sectors, all right? Higher oil means higher transportation costs. Think trucking, think air freight, think shipping containers, last mile delivery costs. You know, if you're going to have the Amazon driver delivering your package, right? But it's not just at the pump either. It's not just a gas station. Even electric cars are going to feel the pinch because electricity costs are also going to go up. Okay, so even EVs are going to feel this impact as well, or even just higher energy costs, higher electricity costs in general. Okay, oil and energy are used across industries, manufacturing plants, data centers, agricultural equipment, mining, construction, plastics and chemicals, to name a few. And then energy is in many consumer products, plastics, fertilizers, chemicals, packaging, and we're going to get into some of these other things later when we cover the Korea announcement. Consumers have less spending power. All right, so gas gets expensive, utilities get expensive, food by extension also could potentially get expensive, because again, you're going to need all this machinery, equipment, freezers, etc., all powered by what? Probably electricity or some type of gas / fuel, right? So all of this gets more expensive because $80, oil starts to climb higher. So this is not fear mongering. All right. I promise this is not fear mongering. But what I am saying is that these secondary, tertiary, different impacts to the economy could start to show if there is a prolonged war. So we need to understand, we need to cover what's happening in Iran. For this reason, right? Opening and reopening that Strait of Hormuz is extremely important. It's paramount at this point, especially for the global economy. All right, so going back, crude oil turns lower as Trump officials signal imminent action to reduce price pressure. China, all right, this is important as well. A lot of controversy, a lot of conspiracies out there of why this warfare is happening in the first place. The Venezuela, and then you have, this stuff happening in Iran, right? Again, in my opinion, it's always been about China. China is the United States' biggest rival, and the United States is going to do everything it can to weaken its rival, basically, right? But China is reportedly in talks with Iran to allow crude oil and Qatari liquefied natural gas vessels safe passage through the Strait of Hormuz, restoring at least some shipments from the vital waterway that accounts for 20% of world oil and LNG supplies. China, which relies heavily on Middle Eastern energy supplies, is said to be unhappy about Iran's move to paralyze shipping through Hormuz and is pressing to allow safe passage of the vessels. Very important. One of Iran's biggest, allies, aside from Russia, is China. But China is not taking really a stance against this. They had one naval ship. Russia and China had one naval ship each as part of an exercise that Iran was conducting. And as soon as missiles started flying from the U.S. side, those ships pretty much left, right? They did not partake in any of the defense of Iran. So again, they don't want the smoke. They're not trying to get wrapped up in all this nonsense, but they're going to try to pressure at least Iran to, not put any pressure in the Strait of Hormuz, not sink any tankers, not attack any tankers. And at least let the energy continue flowing. Additionally, the UAE reportedly is considering freezing billions of dollars of Iranian assets held in the country, a move that could sever one of Iran's most important economic lifelines. All right, so again, if we look at what happened in Russia, when Russia invaded Ukraine, you had Russia kicked off the SWIFT system. This sent Bitcoin higher, certainly gold. And now we see that happening with Iran, right? They're basically getting cut off from their money, so they can't fund their war or defense or whatever. So with an end to the conflict not in sight, additional crude price strength would appear to lie ahead should this conflict extend through the next week. A WTI advance to the $95 area, crude oil, is certainly within realm of possibility. All right, the global oil market will continue to see disruption and price volatility, even if transit through the Strait of Hormuz is partially resumed. All right, Neil Crosby of Sparta Commodities said in a note, the idea that things return to normal once ships start moving again is misleading, as the market is not pricing in the waterways closure, but also damage to infrastructure and logistics across the region. We covered in a previous stream that Saudi Arabia and Qatar are closing down energy infrastructures, right? And it's not something you just turn a switch on and off, right? For Qatar, if they already shut it down, it's going to take 2 weeks to get that whole infrastructure back to operation, right? You have Saudi Arabia, a couple of their areas were struck by Iran drones, missiles, etc. So they have to repair that. They have to go in and repair that stuff. And not only that, you also have the shipping containers, right? You also have the shipping containers you need to take into account. Think from the perspective of the crew of these ships. You think they want to go through the Strait of Hormuz while all this is going on, even though the U.S. is saying, hey, we're going to offer war insurance and we'll pay off the company in case you guys get attacked, whatever. We'll even offer escorts, right? You think the crew on the ship wants to deal with that? They don't care. They want to make sure they get, to and from the port safely, right? They don't want to deal with any of this. So it wouldn't be unheard of if some of these crews just refuse to go through that Strait of Hormuz. And then you have to also factor in how much time it takes to replace that crew, right? How much time it takes to replace a captain, a crew member, et cetera, right? So this is a very fluid situation that's happening in the Strait of Hormuz. And again, those secondary, tertiary impacts to the global economy will start to be felt if this does not come to a conclusion here in the next couple of weeks. All right, because again, countries will start having to dip into their oil reserves in order to make sure that energy prices don't go crazy, right, for their local populations. So really, really crazy. Okay, moving on. So we also have from South Korea, okay? South Korean lawmaker flags risks to the chip industry. All right. The semiconductor industry expressed concerns that rising oil prices could lead to higher electricity costs domestically, which could ultimately undermine the price competitiveness of semiconductors. Okay, lawmaker Kim Yong-bae said after meeting with executives from companies such as Samsung Electronics and SK Hynix. Those are the two biggest electronics companies or semiconductor companies in Korea making specialty DRAM, right? Micron, ticker MU is the other one, but they're US based. All right, Kim said South Korean companies source key chip making materials from the Middle East like helium, and any supply disruption would impact chip production. Logistics, transportation expenses will likely be the biggest issues rising from the situation in the Middle East. South Korea is highly dependent on the Middle East for 14 items used in chip making, including helium, bromine, and chip inspection equipment. Its industry ministry said some of these can be sourced domestically or from other countries, but 54% of its naphtha, I don't even know what that is, imports travel through the Strait of Hormuz, and supplies could be hit if Iran conflict is prolonged. All right, South Korea sources 70% of its oil from the Middle East. An entire country getting 70% of its oil from the Middle East, and that Strait of Hormuz right now is being contested. Some chip makers are downplaying supply concerns. SK Hynix told Reuters it has long secured diverse supply chains and sufficient inventory of helium, because of which there is almost no chance that the company will be affected. Samsung said which is South Korea's largest chip maker, declined to comment. TSM said it does not expect significant impact currently and continues to closely monitor the situation. Contract chip maker Global Foundries, ticker GFS, said it is in direct contact with suppliers, customers, and partners in the region, and mitigation plans are in place. All right, so you guys can see the impacts that it's having on the globe, right, on global economies, and not only that, the stock market, right, the stock market. And again, company or investors are probably not pricing in how important that Strait of Hormuz is for all these other companies, right? Companies that rely on basically energy to run. So we already kind of covered this, and I think it's really, really important that we understand how this closure of Strait of Hormuz is going to impact the broader world. Okay, so from the Kobesi letter, we have some really breaking news, right? 3 of the 4 big Gulf countries, Saudi Arabia, the United Arab Emirates, and Kuwait, Kuwait and Qatar, are discussing withdrawing from the U.S. and other investments as the toll from the war with Iran mounts. And this is per the Financial Times. I could not get that article because it's behind a paywall, so we'll have to rely on the Kobesi letter for this. All right. Details include budget strains are reportedly mounting due to reduced income from energy, shipping, and tourism. Countries could reassess investment commitments to the United States. The move would be viewed as a precautionary measure moves that jeopardize U.S. investments could pressure President Trump, right? Because that was his whole thing when he did the Middle Eastern tour. And we're going to get into this in just a moment. But when he did the Middle Eastern tour, he brought a slew of executives with him. You had AMD, you had Sam Altman over there, you had Jensen Huang, NVIDIA, you had Google over there, you had Palantir over there, you had all these people all doing their tours throughout the Middle East, right? Selling chips, selling software services, whatever, what is it? Shaking babies and kissing hands, right? That's what they were all doing over there, right? But now you have some of these countries saying, you know what, we might have to rescind some of those investments into the United States. And there was $2 trillion worth of U.S. investment in the United States from these countries, right? And that is potentially at risk because of what is going on. So that is a big deal. Again, this just shows the impacts of what this war is currently having, and we'll have to wait and see what these countries, the GCC, I keep forgetting what the acronym is. It's the Gulf Coast. Hold on, GCC. Middle East. I always forget what it is. Yes. The Gulf Cooperation Council, I think is what it is. Yes. The Gulf Cooperation Council. And it has a couple member states, Bahrain, Kuwait, Oman, Qatar, Saudi Arabia, and Kuwait. So yeah, it has a couple of them in there, but anyways, this is obviously going to be a big hit if they start to reduce their investment, whatever they were investing in, probably data centers, right? Probably, in my opinion, it's probably data centers that they're putting their money into the United States. This could, be one of those dominoes for a different bear case against the AI trade. So got to wait and see how this plays out. In other news, all right, so we're past the oil stuff. All right, we're past kind of the macro geopolitical news. But in other news, ChatGPT is releasing GPT 5.4. Okay, and the big deal here, aside from beating Claude and Gemini on most metrics, I don't even truly understand these metrics, but these are the metrics that OpenAI had published. They're basically smoking their competitors in most realms, right? Like browser comp, Anthropic or Claude is still doing very well. But what is the big deal here is that from Sam Altman is they're launching GPT 5.4, available now in the API and Codex, and rolling out over the course of the day in ChatGPT. It's much better at knowledge work and web search, and it has native computer use capabilities. So we're going to see if I haven't even had a chance to check it, but we'll see if we can actually download and install like you can with Claude on those Mac Minis, I forget what it is, but you can install like actual Claude on a Mac Mini. So we'll see if you could do the same thing with ChatGPT. I think that would be super, super cool. So you can start doing your own like agentic AIs, right? You can start having your own agents using OpenAI or ChatGPT. So exciting stuff happening in the AI sector. Okay, moving on from that. Gold and silver slide on dollar strength, renewed inflation worries. All right, like we were talking about earlier, if the cost of oil continues to go higher, we're going to see oil, potential recession, et cetera, right? I mean, those take those with a grain of salt, right? We always hear of the worst doom and gloom whenever this stuff happens. But this is something to think about, okay? A stronger U.S. dollar and rising treasury yields pressured gold and silver on Thursday, reversing early gains as concerns rose that the escalating conflict in the Middle East could drive up inflation. All right, the market is looking at higher oil prices and the potential for inflation, while higher treasury yields usually aren't great for gold. All right, because why would you keep your money in gold when you can get a better interest rate on treasuries, right? That's the idea. However, gold still boasts supportive fundamentals. We're going to, at some point, start seeing evidence of significantly higher deficit in the United States, which we already see. We already know that. We don't make more than we spend. We have a spending problem. The United States has a massive spending problem, something to the tune of $39 trillion, right? That's our debt right now. And a massive amount of uncertainty. All right. Inflation fears have revived along with the possibility of fewer Federal Reserve rate cuts this year, giving higher energy prices, but gold still has gained about 17% year to date, retreating from 5,400. So, is that gold silver narrative dead? Is the gold silver narrative, no longer true? Is it invalidated? Is the thesis invalidated? For me personally, it is not, because these events, right? These events, these geopolitical, these wars, whatever, eventually they get priced in, right? We see it all the time. Whenever these things happen, eventually at first the market short-term, very volatile, sometimes violent drops, sometimes crazy parabolic swings to the upside, right? But eventually everything just goes back to what they call the mean, right? Everything just goes back to normal. And that is, in my opinion, going to be, is going to be the case here. And the reason why, especially for gold, because there is only one question you need to ask yourself. And that question is, do you think the US government is going to be fiscally responsible tomorrow, right? Do you think they're going to be able to eliminate the really bad deficit we have where we're spending more than we make? Do you think, they're going to raise taxes on Americans? Definitely not. Or do you think they're just going to print away their problems, right? The United States is just going to continue printing money. So I'm of the belief that yes, they're going to continue printing money. It is the Trump's administration's goal right now to continue having a weaker dollar, right? So countries can purchase U.S. goods at cheaper amounts. So again, the debasement trade is live and well and will continue. So that is my thesis for gold, and that's why I continue to hold a gold position. All right, for silver, the fundamentals still have not changed. Okay, you guys have heard me say this probably several times now. Silver is an industrial metal, right? It has a lot of use. We covered that it's used in missiles. We covered that it's used in national security, right? Weaponry, defense, that type of stuff. It's also used in a lot of electronics. Okay, you have EVs, you have Samsung's smart battery, or not smart battery, solid state battery that's coming out. Eventually that technology is going to be universal, right? More and more, EVs, companies, cars, electronics, phones are going to have solid state batteries, right? So how much silver is going to be required for all of this? And there's not enough silver to go around. Okay, so again, the fundamental story for silver is that the demand is there. It's just paper price, right? Especially if you're investing in paper, it just has not materialized. It has not caught up. I still think silver will have its, climb back up. But again, looking back at that insane parabolic move up, when we saw with silver, that crazy move up, it was due for a pullback or a correction, whatever you want to call it. It was due for one, because gold or silver definitely should not be moving like that. In my opinion, all right, just based on everything I've read, everything I've seen, these moves in some of these metals is very, I don't want to say not real, but inflated, I guess, or manipulated, right? So that is, just again my take on gold and silver. Anthropic, I'm not going to cover this in depth, but Anthropic CEO says no choice but to challenge the Trump administration about the supply chain risk designation in court. Again, they're not trying to get this. This contract back. I mean, they pretty much already lost it, but they don't want that designation that they are a supply chain risk, right? So they're going to be battling it out in court. So as we stated last Friday, this is coming from Dario Amodei, excuse me. As we stated last Friday, we do not believe and have never believed that it is the role of Anthropic or any private company to be involved in operational decision-making. That is the role of the military, Amodei wrote. Our only concerns have been our exceptions on fully autonomous weapons and mass domestic surveillance, which relate to high-level usage areas and not operational decision-making. All right, so they're going to be battling this out in court to get that supply chain risk designation removed. I don't know if they're going to be able to win, the administration, but two, probably all the federal agencies that were using Anthropic, if they're going to be able to win those contracts back. Because if they still have that supply chain risk designation, which is usually reserved only for foreign companies, it's gonna be hard for Anthropic to do any work, any business with the government, right? And they want to do business with the government. Okay, I gotta get my coffee in. Okay, all right, guys. Oracle plans to lay off thousands of employees due to AI data center build-out expenses, all right, or due to build-out expenses for AI data centers, right? Just going to cover this real quick. All right, some staff reductions will be aimed at positions that could be replaced by AI. Oracle has plans to reduce its workforce by thousands of employees, due in part to its immense spending on expanding data center capacity. Early Feb, Oracle revealed that it expects to raise $45 billion to $50 billion. Again, more capex, right? This is what all the hyperscalers, all the the Mag 7, most of those companies are doing, right? They're just putting billions and billions and billions of dollars into a data center build out, and Oracle is no different, right? The biggest bear case for Oracle is that they're raising way too much debt, right? They're raising way too much debt. It's the same thing we've heard with all the data centers that, they can't see the revenue coming, right? Investors can't see the revenue or the AI capex, the capex spend justify based on the revenue or future revenue. All right, that it expects to raise $45 billion to $50 billion in 2026 to build additional capacity for its cloud infrastructure business. Oracle said it's raising money to build additional capacity to meet the contracted demand of its largest Oracle cloud infrastructure customers, including AMD, Meta, NVIDIA, OpenAI, ByteDance, because they now have TikTok and they're putting it onto their servers, and XAI. All right, earlier this week, Oracle made an internal announcement that it planned to begin reviewing many of its job listings to see if they were all absolutely necessary. Oracle plans to release its third quarter of fiscal 2026 results on Tuesday, March 10th. All right, so another case study of a technology company, getting rid of some jobs and replacing them with AI or probably agentic AI, et cetera. We saw that, but they're also getting rid of employees so they can continue having cash for these AI data center build out. We saw Amazon do this not that long ago. All right, Amazon fired a ton of people just so they can, raise cash to buy chips, basically buy NVIDIA chips. All right, so we saw that. So is this going to be the norm for some of these other companies? Is left to be seen. All right, moving on from that. This is a big news. All right, the big news is probably going to be, I won't say bearish for NVIDIA or AMD. NVIDIA already said that, they're not counting any China revenue. So this is really more or less a nothing burger, but I still think it's kind of important, right? The U.S. molds new rules for AI chip exports, including requiring U.S. investments by foreign firms. So I'm not going to cover the entire article, but I do want to cover kind of the items of that deal, right? According to the document seen by Reuters, even small chip installations of less than 1,000 chips could need a license. Foreign firms that want up to 100,000 chips would need to provide government-to-government assurances, according to the document seen by Reuters, and installations of up to 200,000 chips could require visits from U.S. export control officials, the document seen by Reuters, all right? So basically what this is the Trump administration is trying to get foreign, countries to invest in the United States. We saw that, and now we're seeing that unwind, but we saw that with the UAE and Qatar. UAE, Qatar, Kuwait, they're going to start winding down some of their investments in the United States because of, what we covered from the Kobesi letter. But that model is going to be used pretty much across the board. And it's not a new rule that's been implemented yet. They're trying to get it implemented. If that was to happen, is that bullish for NVIDIA, bearish for NVIDIA or even AMD or the semiconductor companies? I don't think so, to be honest. I really think this is probably more of a governmental thing than anything. I mean, you already have these companies saying that they're not counting on, at least Chinese revenue, right? Or the China market. But this could potentially impact, this could have an impact on NVIDIA or AMD, especially if you're thinking of the Stargate project, right? You think of the Stargate project, they have one being built in the Middle East, and they also have one being built in Europe, right? But you also have European sovereign AI where they're building out their own data centers. They're building out their own data centers. What do you think they're going to be buying? They're going to be buying AMD. They're going to be buying NVIDIA. And if they're hit with this new export rule, right? This new rule, that's not good, right? That's not good. And this is how I could see this being a problem for NVIDIA or AMD. That would be a problem because now in order to get these chips, especially in any size worth a while, they would have to invest, these countries would have to invest in the United States, right? So now it's pretty much the Trump administration strong-arming countries in order to get NVIDIA or AMD chips. Or maybe it's not those. Maybe it's Broadcom, right? Broadcom ASIC chips as well, the TPUs that they have, or Amazon Trainium if they ever sell them, right? Or Google TPUs, etc. So I think this is more, I don't know. It's kind of a nothing burger, but at the same time, now I'm thinking about it out loud. This could probably evolve into something worse down the line. But we have to see if this rule is even going to get implemented. So more to follow on that. Okay. Just checking the chat. Skeptic says we're all about to be jobless and referencing the AI stuff. Yeah, man, you need to learn. We all need to learn skills, man. Skills that pay the bills. But anyways, I digress. All right, Marvell shoots up its Q4 results, guidance tops estimates, and this was this is Broadcom's biggest competitor, but this also lets us know that the AI trade is alive and well. Okay, for the period ending January 31st, Marvell said it earned an adjusted 80 cents per share as revenue jumped 22% year over year to $2.22 billion. Analysts had expected the company to earn just 79 cents per share or $2.21 billion in revenue. Marvell delivered record fiscal 2026 revenue of $8 billion, growing 42% year over year, driven by robust AI demand. All right, Matt Murphy's Marvell's chairman and CEO says, we expect year over year revenue growth to accelerate each quarter in fiscal 2027, driven by continued strength in our data center business, with bookings continuing to grow at record pace. In addition to our strong results and outlook, our design wins in fiscal 26 hit an all-time record, which we expect will continue to fuel our growth, our future growth. So this tells us that the data center play, the data center trade is still alive and well. The AI thesis is still alive and well. But if you're bullish on data centers, I don't know about Marvell. Me personally, I'd rather opt for something like a Broadcom. But this could be a good turnaround for Marvell. So just wanted to cover this because, again, important for technology investing, right? Especially understanding the story. One last bit of news, and then we'll cover an ETF that it just launched from Round Hill. U.S. Rare Earth, ticker USAR, to buy Texas Mineral Resources for a $73 million all-stock deal. All right. USAR said Thursday agreed to acquire Texas Mineral Resources for 3.8 million shares of USAR common stock. All right. The acquisition makes USAR making it the sole operator of the Round Top Heavy Rare Earth and Critical Minerals project in Texas, which the company said is North America's richest known deposit of heavy rare earths and critical minerals. All right. Under the accelerated mining plan, USAR said it expects that by 2030, it will extract 40,000 metric tons a day of rare earth and critical minerals feedstock from Round Top by 2030. So if you're investing into something like a USAR, this is going to be a very, very long-term play. I do hold a position in USAR. It is down substantially at the moment, but again, long-term hold. So that will do it for our news segments, guys. So I hope you guys enjoyed that. At least got a little bit of knowledge. I think the biggest news today was all about oil, right? And the impacts it could potentially have if this war is not concluded, or at least if the Strait of Hormuz is not opened, right? So this is from Round Hill, and this just launched. Okay, this is the Mars Space and Technology ETF, not sponsored by them. Definitely not going to be opening a position in this because I have no conviction in most of these holdings, or pretty much all of these holdings. One, I don't even know most of these holdings. I do know of Rocket Lab, ASTS. The other ones, no idea. But anyways, let's take a look. Round Hill believes the space economy is transitioning from government-driven exploration to commercial-scale infrastructure, from satellite connectivity and launch services to space-enabled data and communication. Space infrastructure increasingly underpins modern economic activity. Mars is an actively managed ETF. So whenever SpaceX probably IPOs, we'll see SpaceX added to this. I would not be surprised if SpaceX gets added to this ETF. Okay, so they're focusing on the space economy from launch to data centers in space and to the equipment or the technology needed to launch those. Right, so they're pretty much focusing on the entire supply chain, if you will. They're pretty much investing in the entire chain. All right. So Mars seeks the exposure to the space economy by enabling technologies focused on space companies, powering industries reliant on space infrastructure, including GPS, internet, agriculture, banking, healthcare, and weather forecasting. I would not have had weather forecasting. That's entirely new to me. McKinsey estimates a global space economy will be worth $1.8 trillion by 2035, up from $630 billion in 2023. So I wonder if we'll get space mining, right? I think that would be super cool. Imagine if we're like Elon Musk is probably going to be the one to do it, in all honesty. If Elon Musk was to, start exploring space somehow, some way, and then land on an asteroid, and this asteroid is just full of gold, I wonder what that would look like, right? What that would look like for gold, because that would be crazy. But we could look at some of the holdings. We have Rocket Lab, ASTS Space Mobile. We covered ASTS Space Mobile briefly in a stream a long time ago. They're basically they have satellites, LEOs, low entry orbit satellites that do cell phones, that do data, internet, that type of stuff. So this is like AST is pretty much the competitor to not data center, but telecom companies, telecom REITs like American Tower, cell towers, or CCI, Crown Castle, Inc. So those are two companies that would be competing with AST. I honestly did not think that technology would come as fast as it did, because I was very, very bullish on AMT and CCI, both telecom tower REITs. But ASTS, I think, has proven itself and has proven the technology is worthwhile, right? The biggest bear case against something like LEO was that how do you fix it, how do you maintain it, how do you repair it, the cost of launching these satellites, et cetera, and then does the revenue actually justify all that? And ASTS does look like it's doing very well in that space. So yes, the costs do justify it. But yeah, Planet Labs in here. Let's see what else. Intuitive Machines, I've seen this one. I don't remember what they do though. Let's check on the chat here. Sergio says, what is going on, gang? Totally missed the beginning of the stream. Well, we covered a lot, Sergio. We covered a lot, especially when it comes to the oil, Strait of Hormuz, Iran conflict. Then we moved into some, AI data center, news. And now we're just covering the CTF that just launched from Round Hill. So it just launched. Again, me personally, not going to be opening up a position of any sort. We could look at the full holdings. I don't know why it looks like this. Let's see. Okay. Let's see what else we have in here. Voyager, another big one. Man, I've not heard of a lot of these. Looks like, yeah. So looks like they have a Japanese company in here. I don't know what LN is. Yeah, I'm not sure what LN is, but they do have, they have 3 Japanese companies in here. FP is probably French, maybe. Here's one Chinese company. I think this is probably UK, maybe Great Britain, and the rest are American. So yeah, not bad. Not bad. So that will pretty much do it for the news stream and for the ETF stream, guys. We are running at about an hour. So I will open up, if anyone wants to come on for the last 15 minutes of the show before I get up on out of here, or if you guys have any questions, or if you guys want to talk about anything related to the news stream that we just talked about. But I am pretty much out of content for today. I need a sip of coffee because my throat is pretty damn coarse right now. Oh, that dead air. I love that dead air. No sound. Okay, Skeptic, do we have any ETFs that we can also review while we're waiting? Let's see. Let's see. Does anyone have any good coffee recommendations while I'm at it? Because I am shopping for coffee today. I need coffee. I am out of everything. I don't even have instant coffee. I hate instant coffee, to be honest. Like, instant coffee is not my go-to. I don't like the creamer. I don't like the sugar that they put in all this stuff. I drink my coffee black. Yeah, I'm just not a fan of instant coffees. They taste so bad. There's one instant coffee I found, one brand that I did more or less like. It was pretty enjoyable. But again, it's such a strong taste. And if you screw up the water an instant coffee, ratio. It's either way too bitter or way too watered down. Like I don't know. I could never quite get it right. But if anyone has a coffee recommendation, please put it in the chat. Anyways, going back to ETF and filings. Let's see. We already covered the Tuttle stuff. We covered the Tap Alpha stuff. YLDB. I think we looked at ATCL before. Yeah. 0 DTE auto callable. Padre says Black Rifle Sasquatch. I will have to see if I can get some Black Rifle. I think I had their coffee like once when I was working overseas. Got to support the veteran-owned business. I believe I did have Black Rifle. But if we have any military aficionados up in the chat, the biggest coffee and you guys would know this, right? You would know this. If you deployed anywhere, you would know green bean coffee. Probably the unsung hero of both the Afghanistan war and the Iraq war, right? Just green bean coffee. Wherever the troops are, that's where, they'll be right next to you. And I have went many a day with green bean coffee. They had something called, what was it, the MOAC, the mother of all coffees? And it was like 5 shots of espresso or something, 5 shots of espresso and regular black coffee for, I think, like $4 or $5 a cup. And the cup was huge. But man, yeah, the MOAC. Let's see. We have from Comic Book. Hey, thanks for joining. What's the best investing advice you ever received? That's a good one. Let's see. Best investing advice I ever received. It's hard to say. I'm trying to think of one, and this is like on the spot. So I'm trying to think of something that stuck with me. And I honestly can't think of one. I can't think of any advice because I stopped taking people's advice a long time ago. True story. I was trying to do a startup business a long time ago, and I was listening to a bunch of people, and basically the business, long story short, the business just collapsed on itself. I lost a ton of money. And that's when I learned never to take advice from people ever again. Like, never take advice unless they have skin in the game, unless they actually know what they're doing, or they've done the work, right? They've done the work. You can see that they've done the work. This is why I don't listen to a lot of people, right? It's not because I'm hard-headed. It's just I don't listen to a lot of people unless, one, they have skin in the game, or two, they got to be like some type of expert, in the space. They have to have, the scars and the battle scars to prove it. That's pretty much it. That's been my philosophy for a very, very long time, is not to listen to other people. Now let me pair that off with there. You can do your own education, right? You can get your own education. You can learn from other people. There's nothing wrong with that. You can take what other people say. But you have to filter it out, right? Like, especially in the YouTube space, a lot of good-hearted people, a lot of good people that just want to, share investing advice or investing philosophies or their own investing strategies, et cetera, right? It's all good stuff. But, a lot of that you got to take with a grain of salt. A lot of that you really, really have to take with a grain of salt, because you have to do your own due diligence. You have to do your own work. Like that gentleman we had yesterday, who came on as I was discussing the 2 ETFs, and he was like, useless information. I mean, that's the type of guy who's going to buy an ETF because a YouTuber covered it, or someone on X said it's, the best ETF. And then he's going to ask questions. Why is it going down? And then he'll start saying this ETF is trash. Right. I've been in that situation, right? I've been in that situation. So I'm speaking straight from experience, I suppose. But yeah. Let's see. How is ORR doing? Well, let's see. Year to date, up almost 8%. Had a really nasty dip. Is this just like the ulti with no income ETF? I know we covered this before. Like, we looked at this before. This was what, like a SPMO or something, like a knockoff SPMO. Yeah, hell no. Look at that. Damn. let's see. Yeah, see, expense ratio of 14%, but you know, they take away all that stuff, and then you're just left with the 1.3. Yeah, so that's how ORR is doing. Champ says, thanks for the stream, bro. Any oil ETFs, USO. So USO is really the only ETF that I know of that's a pure play. But you can also look, we covered it before. You can look at BWET. BWET is futures contract for tanker shipping. It's not exactly oil. But if you want to get at least a derivative of oil, tankers are a big deal. We could look at B-Dry, I think, as well. Yeah, that's dry shipping or bulk shipping. I don't know. But yeah, there's that one. If you're looking for some type of income, I think Defiance is the only one I know of that has USOI ETF that does option income off of oil. But again, this is Defiance, right? So not advice to go buy it. Wow, look at that. Holy crap, that's actually pretty impressive. That's actually pretty impressive. I did not have that on my bingo card. But yeah, here you guys go, right? NAV erosion, right? NAV erosion. Oh, NAV erosion. So we got to say that 3 times. But again, this is an option income ETF, cover call, capped upside, blah, 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 blah. You guys know that already, right? And this is obviously from Defiance. Defiance does not have the best reputation when it comes to this stuff. Skeptic says BWET or maybe MLPA, since MLPs are oil pipelines and travel. Yeah, so you can look at like the derivatives, second, third, fourth derivatives of oil instead of playing on oil spot price. And what I mean by derivatives is you start looking at the pipelines, you start looking at the shipping companies, not manufacturer, but the refineries. You can look at those types of plays as well. This is nice. I like how Neos came out with this. Truth be told, I've also considered adding this to the portfolio, but I've been holding off. But year to date, up 11%, not bad, right? So if you're looking for some type of income, but the problem with investing in MLPs, master limited partnerships, right? That's what MLP stands for. You usually get issued, I believe, a document called a K1. Right. I've never invested in MLPs, but I invested in real estate, and real estate, they give you what's known as a K1, right? So you get to, track the losses and the gains, use the losses to offset some of the gains for tax time. Of course, not tax advice. But the other crappy thing about investing in MLPs is you're going to get a ton of K1s, right? And that can increase your tax bill by a lot. But when you invest in something like from Neos, MLP Energy Infrastructure, you don't get a K1. This is a 1099 div that you're going to get at tax time, right? Which is really, really nice. So if you want a simple income-based play on a derivative of oil, you can look at something like MLP or even something like BWET if you want a pure play. Or not a pure play, but if you want another derivative, play on oil. Yeah, it's going to be interesting to see what happens. Let's see what else we have. From the working investor, that Defiance oil went down like an oil spill. Yeah, it did. It definitely did. Hey, working investor, man, you might have to eat your own words here soon. Look at this bad boy. Starting to come back up. You're going to have to send Sylvia an apology. So JF, yeah, we covered USOI. That's funny. ETF like USOI, like USOI boy or something. Let's see, from Sith Mordor. Welcome back. I'm pretty bullish on SLVO. I got 2 shares and got a $16 dividend, and I'm still in the green even with silver taking a hit. SLVO, that's Amplify, I think, right? Yeah. Well, not Amplify, but yeah, silver backed or silver income ETF. So that's awesome. That's awesome to hear. Year to date, down 4.42%. I mean, it's kind of expected. Again, this is the big one: cover call, capped upside, unlimited downside capture, right? Or full downside capture, I should say. Let's see. From Padre, IH for oil services. Let's see this bad boy. Oh, it's from Van Eck. Year to date, 27.92%. Damn, look at that. That's really nice. I like this one. I might have to look into this one. Blah, blah, blah. Let's get rid of this. So Van Eck Oil Services seeks to replicate as closely as possible before fees and expenses the price of yield of performance of U.S. listed oil services 25 index, which is intended to track the overall performance of U.S. listed companies involved in oil services to the upstream oil sector, which includes oil equipment, oil services, and oil drilling. Nice. I like this one. It's damn, that's a lot. I mean, for an ETF, hell yeah, that's a lot. Really, really nice. Let's take a look at how this has been doing, not just recently, but over time. 1 year, of course. Yeah, 33% over the last year. It's up 52%. This was Liberation Day. And then, yeah, it just had a really nice climb back up, almost 100% over the last 5 years. Oh, baby, look at that. That is crazy. Damn, there must have been some type of splits or something. $1,500 a share? Damn. All right, well, there you guys go, man. We got a bunch of tickers if you want to play on oil. And again, oil, I think, is going to be hot, and you got to keep an eye on the news, because if Iran wakes up one day and says, you know what, we want peace in the Middle East, we don't want any more war, Strait of Hormuz can resume, and then you have Qatar, Saudi Arabia reopening their facilities. I wonder if oil will probably come down a lot in price. I'm pretty sure it would, and these ETFs would obviously probably follow suit with that. It's just my thoughts. Normally MLPA is special, no K1. So no K1 for MLPA, which is it's from Global X. So that's good. Yeah. When you start having multiple K1s, at least, again, not financial tax advice, whatever. Some investors love K1s. Other investors hate K1s. You got to kind of find out which camp you're in. For real estate, I like having K1s. I don't like having to pay extra money for my tax person to deal with the K1s. So, especially if you're investing in multiple, like probably, 20, 30, 100 MLPs, that K1 can get pretty nasty, right? That K1 fee can get pretty nasty. Get you some green coffee company and buy some Bitcoin and gold. Well, you know what, Sergio? I'll take that advice. I told myself I was not going to buy more Bitcoin until later. But I pulled the trigger and ended up buying an additional batch of IBIT, somewhere to the tune of $10,000. So I increased my Bitcoin holdings. In IBIT. So in IBIT shares, I'm at 1.62% last I checked, or 1.62 in Bitcoin when converted from IBIT shares. So I'm almost up to 2 Bitcoin. I really, like I said, I want to get to 2 Bitcoin. I don't know if we're going to go lower. I have no idea. I want to go lower so I can acquire more IBIT shares at a cheaper discount, but I don't know. Just from what I'm seeing, it's probably, it's probably not going to happen. I have no idea. It's still too early. The 4-year cycle, crypto winter, risk off, environment. But this is why I keep following IGV, because if that risk returns, right? If this risk returns, I think IGV is going to be that indicator that lets us know, like, yeah, we're back in a risk on environment. All right. We also have to wait for liquidity to continue coming into the market. Quantitative easing, interest rates coming down, waiting for the Fed to say, hey, we're going to be printing lots and lots of money. Right. See, ISBG is good, but I like to control the allocation or the weighting for gold and Bitcoin for me personally. Like if one drops, I want to be able to put more money into like Bitcoin or gold, right? I want to be able to do those individually. ISBG, you don't really get that option. You're leaving it up to the fund managers to pretty much decide for you. I personally like just having two different holdings. I'm willing to pay that that expense ratio in order to do that, right? For IBIT, it's like 25 basis points. For gold, I think I don't even know what it is for GLDN. But yeah, I'm pretty sure that expense ratio is not really all that high. But at least that's my strategy, I suppose. That's my philosophy is, I'd rather be able to self-allocate instead of leaving that up to an ETF. But hell yeah, I'm all for buying more gold and more Bitcoin. I might, still thinking about it, I might increase my gold position. I haven't touched it since I first dropped into it. I'm still up about, let me check. Actually, what am I doing? I hope I'm still logged in over here. I think I'm still up like 20% on my GLDN position. Let me check. Come on, internet, work with me. Yeah, so for my GLDM, not GLDN as in Nancy, but M as in Mike, I'm still up 21%. All right, so I wish I dropped 100K in there because I would be up $20,000, which would have been nice, but I digress, right? I will take those gains. And again, it's used more as a hedge. The only problem with investing in these spot price gold ETFs is the tax situation if you sell, right? That tax situation is pretty gnarly because depending on what you're investing in, you could be paying a 30% collector's tax, right? Which is what you would pay, I suppose, for gold. Now, don't quote me on that. That is just from what I read. You don't pay the capital gains like you would normally on like a stock. You would pay a collector's tax on the commodity of gold. Again, do your own research on that one. Well, ladies and gentlemen, I think that'll do it for me. Out of the 44 we have 12 from X and 32 from YouTube. And I appreciate each and every one of you joining me for this stream. All right. But with that being said, I hope you guys enjoy the rest of your night, your evening, or your day, wherever you are in the world. And I will see you guys in the next stream. And as always, you guys take care. And again, I appreciate everything. All right. So take care, guys.